What is going on, investors? Welcome to my channel. This is Jason, aka the Frugal Investor. In this video, we are talking about one of the best books of our time, the Dhandho Investor, written by one of the best value investors of our time, Mohnish Pabrai. Mohnish Pabrai runs the famous Pabrai funds, which has returned over 517% from 2000 to 2013. He also paid $650,000 back in 2007 to have lunch with Charlie Munger and Warren Buffett, which are his heroes. In this video, we will go over the stories that he shares in the book and his principles and strategies when it comes to value investing step by step. Please don't forget to like and subscribe. With that said, let's get right into it. Mohnish starts the book with the story of the Patels. Patels are a small community from the Gujarat state of India. They came to the United States back in the 70s with little to no money and no knowledge of the English language. Today, they control over 60% of the United States motels, which is more than $150 billion in today's value. Just a small community of less than 0.02% of the United States population controls more than 60% of the United States motels. How did they do it? By following a simple framework of Dhandho. Dhandho framework is based on the principle of heads, I win, tail, I do not lose much. When the Patels came to United States, there was an oil embargo that was going on with the Arab countries and the United States. The oil prices were sky high, so very less people were traveling on the roads, and due to that, the motels were struggling. If people don't travel, who will come in the motels to rent the rooms out? The motels were struggling and were selling at cheap prices. The Patels saw this opportunity and they would collect some money, less than $2,000, $3,000, go to the bank and get a loan on the motel and buy the motel. When they get into the motel, they would fire all the staff, they would reduce the operational costs, the family would live in one of the rooms and they would work day and night to manage the motel, and that way they would reduce the price of their rooms as compared to the competitors. When they would reduce the price of the rooms, their motels would be running at full capacity. Their motels would be full because their prices were lower than their competitors. And that is how they survived and they managed and they thrived, and that way they took out most of the competition when the competition put their motels up for sale. And they kept on buying and buying and buying. And one Patel after another, they kept following the lead, and that is how they're able to control an empire of more than $150 billion and more than 60% of United States motels and hotels, only controlled by less than 0.02% of United States population. Heads, I win. Tails, I don't lose much. If the motels don't work out, they can always go back to working at a grocery store or working at a gas station and making the money, saving the money and making the money back again, and then using it to buy some other motel or some other business. It's only $2,000-$3,000 of their own money, but the upside was huge. If they win, they would be able to live for free, not pay any rent, and also get a job. They don't have to work for anybody else, and also they can make extra money if the motel does good and keep buying on more motels. Even if the motels did not do well, the banks would not take away the motels, because what would a bank do with a struggling motel? So they would work out flexible loan details with the Patels, and they would keep them running the motel, and down the line they would either collect more money down the line, or they would change the payments, they would change the interest rates on the payment, and they would work out some flexible rules. So but tails were not losing at all. So heads I win, tails I do not lose much. This is the Dhandho framework that they followed to control such an empire. Now, people like you and me, we cannot go out and start buying motels. So what can we do to apply these strategies in our life? Mohnish Pabrai puts it out step by step. The first step in this process is really simple. Invest in existing businesses. Buy stocks of public companies traded on the public stock exchanges. When you're buying a stock, you're buying a share in a public company. You are a part owner of that company. So invest in existing businesses. That's the first step. The second principle is invest in a business with slow rate of change, a business that does not change very fast with time. That is businesses like Coca-Cola, Costco, or See's Candy. The benefit of investing in businesses with slow rate of change is that you can predict their cash flow 10 years ahead, 12 years ahead. It is easy to get a sense of competence in that business. While the businesses that are continuously changing with time, it is hard to grasp what the cash flows will be 5 years from now, 6 years from now, and also where the business will be in 5 years from now, 6 years from now, which increases the risk of our investment. So invest in businesses with slow rates of change. The third principle is invest in distressed businesses in distressed industries. Businesses that are going through a tough time, and the whole industry is going through a tough time. It can either be due to cyclicality or it can either be due to short-term fears. For example, banks back in 2020. In November 2020, the whole market was recovering and was entering a bull market phase while the banks were struggling. People were still fearful around banks if they will recover, if they have enough resources to survive this pandemic. What if this pandemic goes on? And that was the perfect time to buy the banks because the banks had so much cash on their hands. The Fed had set up strict restrictions in 2008 what the banks can do and cannot do in case of crashes. And that is what the banks were doing, and they were ready for any sort of long-term COVID crash. And that was the best time to buy banks, and that is when I built up my positions in the bank, and I am up by almost 50% just in the past 9 months alone in my position in banking. So buying distressed businesses in distressed sectors at the right time can be a huge benefit, like cyclical businesses, like banks, like railways, businesses like that go through cycles of distress and the prices come down and short-term fears circle those prices, and that is when you can get in and build up those positions. In the long term, you will do really well. The fourth principle is invest in businesses with a moat. A moat is an unfair advantage that a business has over its competitors that its competitors cannot replace. So for example, Facebook has a moat with which 1.9 billion daily active users that it can leverage that its competitors do not have, and that user base gives it a moat. Costco has a moat with a direct-to-consumer sale model and low margins on their sales, which is hard to beat by any company at such a scale. These are the type of businesses that will survive tough times, while their competitors might not be able to do so because these businesses have a huge moat and they are essential. The fifth principle is few bets, big bets, infrequent bets. Markets are mostly fair priced. To look for mispriced opportunities, you have to look hard in the deep crevices of the market, and they are one in very few. When you find them, you have to bet big, and they come in very rarely. Over the course of your life, you might have 10 to 11 few bets that you can bet big on and that you can win big on. Few bets, big bets, infrequent bets. The sixth principle is fixate on arbitrage. Arbitrage spread is similar to a moat. Arbitrage style investing follows the principle heads I win, tails I break even or don't lose much. If gold is selling at $700 an ounce in London and 710 in New York, you can move between those places and you can get the $10 spread on gold, which is arbitrage. Arbitrages are temporary and competitors soon catch up, so you have to milk an opportunity where you get an arbitrage. The next principle is margin of safety. Margin of safety is the principle when you buy businesses at a big discount to their intrinsic value, and this discount gives you a buffer. For example, Alibaba. Alibaba is trading at $157 a stock, while the intrinsic value suggests that the stock should be trading at close to $240 to $250 per share. That is the margin of safety. The intrinsic value suggests the price should be higher, while you are buying it at a price which is much lower than the intrinsic value. That is your buffer. Good businesses that are available at a great price, great earnings and revenue, but still trading cheap. The next principle on this list is low risk, high uncertainty. Low risk, high uncertainty. That is, invest in a business where the risk of losing your money is too low, but there is uncertainty in the future of the business. Example, Alibaba. Alibaba is going through a high uncertain time. We are unsure about the future of the business, but the business has a great intrinsic value. It is a very solid business with increasing amount of revenue in one of the biggest markets in the world. Low risk, high uncertainty in the future. That is the eighth principle. The last principle is invest in copycats rather than innovators. Copycats steal products that work. Example, Microsoft, MS-DOS, PowerPoint. It almost picked up and stole all of its product except one. The Patels, who followed the lead of the leading Patel who bought first Motel, and all the Patels followed after him. They were the copycats, rather not the innovators. In summary, invest in businesses with the mindset of heads I win, tail I do not lose much. That is, businesses that have a strong fundamental, great growing revenues, they're in great markets, but they have huge uncertainties around them in the short term. It can be uncertainties due to cyclicality, or it can be uncertainty due to bad news. Buy businesses that are trading at prices below their intrinsic value, as in the short term. Buy businesses that do not change rapidly with changing times. That is, their cash flows are predictable and they have huge moats around them and a competitive advantage that cannot be replaced by their competitors. When you find a business like that, bet big, because the opportunities are few and far between. In my opinion, this is a great book for any long-term investor or anybody who wants to learn about value investing and long-term investing. Read it multiple times, and every time you read it, you will learn something new. Please don't forget to like and subscribe. Thank you for watching. This is the Frugal Investor signing out.